Hello, and thank you for clicking in to this video edition of our weekly strategic insight. It's very important at times like this, with all the volatility and all the crazy news flow, that we get into your inbox or into your ears or before your eyes as much as possible. This is when we need to over communicate to try and give you as much comfort and confidence as possible during these crazy times. By mission, we exist to enrich your life by providing clarity. I'm going to do my best to provide some clarity to you of the next 30, 45 minutes. So for this format, you may recall we did this earlier in the year. We decided to just make it conversational. So I actually have no slides to present to you today. And I have with me Teresa Bailey in our Nashville office, who is going to represent you, clients, friends, prospects, perhaps, of W&A, with the questions that we most often field here. And I'm going to offer just off-the-cuff responses. And hopefully, this will give you some insight into what we're thinking and some comfort as you work through your weekend. Hello, Teresa.
Honored to take on the role. And what fun do I have? I get to pester you with questions. And I get to make you say things that we all understand.
Okay. All right. So you get to translate too.
Yes. Well, yes. As long as you agree that I can interrupt you and ask when I don't exactly understand what you're saying and get you to say it maybe in a different way.
You may.
Thank you. So my first question this week would be, what in the world is going on in the UK? And should we be worried?
Yeah. So let's put something in perspective first. There are macro considerations that we'll talk about for what's going on in the United Kingdom, but at the micro level, the UK represents about 2% of the global economy. So from an earnings perspective, and we invest in companies, not governments, it's not that material, okay? But I do think what's happening there is very demonstrative at a micro level of what's happening at the macro level. First of all, I believe we're in a global political depression. We just have a really invasive and intrusive political class all over the planet right now, right? We have in the UK, we had Truss, the prime minister who just walked away, had revealed a bunch of tax cuts that were not paid for. And that unnerved the markets there, especially while the central bank is tightening. So fiscal stimulus, central bank, restraint. We've got it here in the US, Biden with all that stimulus at the executive level, deficits blew out this month. At the same time, we've got Powell with restraint. At the same time, we've got Putin trying to wage some sort of Pyrrhic war against not only Ukraine, but from a resource perspective, Europe as a whole. And then you've got China rolling shutdowns of its economy and all of the regulatory interventions there. So we've got way too much government involvement right now in the global economy, and that's what got the UK upside down. So let me walk you through the credit issues in the UK, because I do think it's interesting about what people in Wall Street are worried about right now. So in the United States, going back in the time machine to 2006, 2007, there was a belief on Wall Street that US housing prices would never go down. And because of that, we created all these derivative structures that blew up when US housing prices went down. Well, in the UK, they had a belief that interest rates will never go up. And so they created a whole bunch of derivative structures around the theory that interest rates will never go up.
Pause.
And then,
what is a derivative structure?
So that's complicated, but essentially it is borrowing money, using leverage to place bets that happen outside of the ticker tape. You're not seeing it in the stock market ticker tape. You're not seeing it on the bond market ticker tape. You're not seeing it in the currency. Going back to 2008, we called it shadow banking. Things that were happening in the system that we couldn't see. And that was the stuff that ended up causing all of the problems in 2008. So what's happened in the UK is, because the pension funds all believed interest rates would never go up, interest rates went up, and suddenly they were in trouble. They were illiquid. They were getting margin calls, and the central bank had to intervene. It revealed, oh boy, we have a shadow banking system again. So
Ah.
that's what's making everybody nervous. The question is, are the authorities better equipped to deal with disruption in the shadow banking system today than they were in 2008? And I would say absolutely yes. So I do think what's happening in the UK is interesting. It reveals that we've kind of hit the wall on modern monetary theory, on the idea that you can just stimulate as much as you want. Because obviously the bond market said, no, you can't. Interest rates went through the roof. The Fed had to intervene. The UK central bank had to intervene. And so number one, politics is run amok. That's why they've got a leadership turmoil. Number two, there are extremes that you can reach in stimulus where the bond market goes time out. We're not going to let you do that anymore. And number three, what's happened over there has revealed that there is a shadow banking system out there that we need to be aware of. So it was great as smelling salts for the market. It was better as smelling salts for the Fed, because then they realized that they are putting so much stress on the economies outside the US, and they cannot just create global catastrophe and turmoil and have the US, not be impacted by that. So I'm happy that, it's sad for the UK because it's a very difficult environment over there, but I'm happy that it revealed to the Fed that there are some consequences to this ever rising dollar.
So how do you think that will impact future Fed decisions going forward?
So my daughter writes for the Papyrus, which is the Taft newspaper. And she called me last night. She said, Dad, what is the Fed trying to do? I'm so proud of her. She's 16. And I said, number one, they want you to lose your job. Number two, they want the value of your house to go down. And that is because the biggest inputs into CPI, Consumer Price Index, are wages and rents. So until wages and rents start rolling over, rents have rolled over some, wages have not, the Fed is going to stay engaged. Okay, so we're going to get 75 basis points more on November 2nd. That'll take us to 4%. Then we're going to get 50 to 75 basis points more in December, because wages and rents don't really decline that fast. Inflation is declining, but it's not going to decline fast enough to take the Fed off of the brake pedal. So we'll see another rate increase December 14th, 75, 50 basis points. And then a lot of talk about a rate hike happening on February 2nd, another 25 basis points. So that would take us to 5% from 3.25 where we are right now. That would be pretty significant. The Fed has told us 1,000 different ways through 1,000 different reporters that they want to see rates at least to 4.5 by year end. So I think they're dedicated to do that, but the Fed does recognize that if they continue to press the dollar higher, if they continue to push the interest complex higher, they are inviting financial instability. So if they break something, inflation comes down, the Fed pivots. If they don't break something, inflation comes down, the Fed pivots. So both are a pathway to lower interest rates and lower inflation. It's just a question of how disruptive they are.
Do you think we are on the verge of another financial crisis?
I do not. So we have to be vigilant too. And so the credit stress that was revealed in the UK forced everybody, us included, to go back and look at credit conditions all across the planet, right? Normally, when you have credit stress after a rise in the US dollar, the stress manifests in the emerging markets. Go back to 1998, we had the Russian currency crisis, we had the Thai baht crisis, we had the Asian currency crisis. Well, those countries learned a lot from that experience. They put a lot of dollars into their bank accounts so that they had plenty of dollars on hand. A lot of their currencies pegged to the dollar, and so they weren't free floating anymore. And so right now, if you look at emerging market debt, there's not crisis level spreads there. So that market's pretty calm. If you look at developed market debt, there is, the UK's interest rate right now is 4% on the 10-year. I think the Greek interest rate is higher. I think the Italian interest rate is higher. but they're still all within range, and still less than ours here in the US. So yes, it is right to be concerned. It is right to be vigilant. But when you dig into the high yield market in the US, or you dig into the corporate bond market, or you dig into the emerging market, or you dig into sovereign debt markets in developed countries, there are not spreads that are blowing out. So for instance, right now in the US, high yield spreads, that's the amount of yield you get for high yield, which is low grade corporate paper over treasuries, are 5%. In 2008, they were 22%. So we're nowhere near indications of credit crises in the indicators that we follow.
So break down a little bit more the credit spreads blowing out, because I think that's interesting. I think you used 5% versus, was it closer to 30?
22.
22.
So treasuries are, whether you believe that the US can continue to run $2 trillion deficits or not, everybody in the globe wants our currency. Everybody on the globe puts money into our bonds, because the way you buy our currency is through our treasury market, more or less, if you're a large institution abroad. So plenty of money coming to the US. So the risk-free rate for the planet is the 10-year US treasury bond. That's known as the risk-free rate. And then you can see how other bonds price and yield relative to that. So right now, high yield bonds are 9%, high yield bonds being low grade US corporate paper. The 10-year bond is 4%, so the spread is 5, right? Yeah. If you were seeing a lot of distress, that spread would be 10. That spread would be 15.
Because why?
Because people will make you pay them higher yields to hold paper they don't trust.
Got it. Okay. Greater risk requires
greater spread.
Yeah, greater spread. Got it. Okay, so talk to me a little bit about earnings and what's going on with earnings right now.
So I literally just had this conversation with a reporter from CNBC. People who are forecasting the collapse in corporate earnings have not done their homework, and here's why. And we wrote about this a couple of weeks ago. The US economy shrank 1% in the first 6 months of the year. US earnings went up almost 9%. How is that possible? Well, when people talk about the economy, they adjust for inflation. When people talk about earnings, they don't adjust for inflation, right? So the inflation rate is 8%, right? So if you cleansed your earnings by the inflation rate, you'd get down to 1%. So you'd have -1 for the economy, 1% for earnings that make companies manage their margins. So inflationary environments historically are actually good for earnings. Now, we've talked about it and you commented on it. It's a money illusion, right? But it doesn't really matter. That's how it shows up in the history books. So earnings right now in this quarter in a moribund economy are going to grow 3%. Next quarter, they're going to grow, call it 4 or 5%. The estimates for 2023 inclusive, and it's 100% now probably, that we're going to have a recession, and we can talk about the implications of that. But inclusive of the recession are still 7%, right? Now, how can you have 7% earnings growth if you have a recession? It's because you still have inflation present. So even if inflation tapers off next year, and I think it will, we still end the year at like 3.5% probably, unless something draconian happens, the Fed breaks something and inflation just goes, deflates overnight. So there's a tailwind to earnings from inflation. Most people don't factor that in. So in inflationary periods like 1981, even in the 70s, earnings grew during those periods. And so they've grown this entire period. So the market's down, or was before the rally, that started last Thursday, which we told you was going to happen in last week's email. But the market, has discounted 30% the valuations they had going into this year because it's come down, earnings have gone up. So this has just been a collapse in valuations because the earnings have continued to rise with a little bit of tailwind from the pricing power of inflation.
Oh, I don't know which way to go. We could go towards tell me more about recession, or we could go towards what to do with cash, because I heard those two things possibly playing out in what you just said.
They are the same thing. And that's probably the most fun topic for this conversation. So all right, so when does recession happen? What we watch most closely to indicate an oncoming recession is the trailing 6 months average of the leading economic indicators, right? And any of you who are interested in that, I'll send you the chart. It's negative.
He means it.
Yeah. I know it's killing me not to have a chart right now. But the data shows that once the LEI's 6 months trailing average roll over, you've got about
LEI, leading economic
Economic
indicators,
indicator.
so statistics that you're looking at
yeah,
that
yeah,
indicate things.
right. And there are like 6 or 7 components, and I can go to all that if you want, but you don't. But once the LEI rolls over, you got about 7 months on average before a recession starts. Okay, so it rolled over, I think, last month. So that would indicate a recession in the first quarter of 2023, like a legit recession. We've actually recessed in the first
Can
half.
you define recession? Because we hear it a lot. I'm not sure everyone really knows what the technical term is and what it really means to
me, now the government has changed its mind on what a recession is, because it doesn't want you to consider that the first 6 months, it's an election year. And they don't want you to consider that the first 6 months of the year was actually 2 quarters of negative GDP growth, which technically is a recession. But the way that the NBER, National Bureau of Economic Research, defines a recession has more to do with the employment market. And so even though we had negative GDP growth, real GDP growth in the first half, unemployment stayed very low and in fact ticked lower. So therefore we weren't in recession. But based upon my textbooks, negative GDP is recessions. So now we're talking about a recession that not only has negative GDP growth, but will likely see job losses. Remember, the Fed wants 2 million of you to lose your jobs. They just want that. They want the unemployment rate to go from 3.5%, where it is today, to 5%, right? They want it. And companies heard them, right? So we're starting to see some layoffs. Nonetheless, so the other indicator that we look at to signal a recession is an inverted yield curve. And that's probably 20 minutes just to figure out what I just said. But the yield curve is the 3-month, the 1 year, the 2 year, the 5 year, the 10 year, the 30 year. And when things are healthy, the curve does this, right?
Meaning you get paid more the longer that the term is.
Correct.
Yes.
Right. Now, when it's inverted, you get paid less the longer the term is, because the idea is that interest rates are going to fall in the future because you're going into recession. So a lot of people consider the 10-year and the 2-year, and the 2-year right now is like 450. The 10-year is 425. So it's inverted there. But if you look at the 3-month, the 3-month is, call it 3.25, where the Fed funds is. It's still below the 10-year at 4.25%. But by December, if there are 2 rate hikes between now and then, the curve's going to fully invert.
So does the curve look like? I mean,
it's ugly. I mean, it's a very ugly curve right now. Yes. And so we're going to have an inverted yield curve. We've got LEIs rolling over. So we're going to have a recession. And that's going to happen probably in the first quarter of the year. Recessions tend to last, call it 8 to 9 months on average, if you go back and look at the last 7. During recessionary periods, markets, depending on which data set you're looking at, go down or up about 1%. So during recession, they don't really move all that much on average, because the damage gets done prior to the recession. Markets look a year forward. They are a discounting mechanism. We've already done the damage going into the recession. Now, 6 months after the recession, markets are up 7% on average. 12 months after, 16%. 24 months after, 20%. And the hit rates just get better and better. 5 years after, 80% higher.
So I'm going to pause right there, because I know I'm having the thought. I know many viewers out there will have the thought, well, it sounds like you've got all this figured out. So can we like go to cash or a safe place, and then we'll just get right back in right for these timelines?
No.
Why?
Well, as I wrote in last week's email that everybody read twice, I'm sure, when you get into periods of extreme market volatility like we're in, that's typical of the end of a cycle, not the beginning of a cycle. Also, you can miss some substantial gains if you hit eject at the wrong time. So last Thursday, there was a huge reversal day. Last Thursday to today, this is Friday when I'm recording this, about near the close, the market's up 7%. When it moves, that volatility can move down and it can move up too. And if you miss that upside volatility, and we're closer to more of that than further away, then you end up being substantially behind the 8 ball. So the damage has been done. The US is trading at 15 times earnings. The world outside the US is trading at 12 times earnings. Europe's trading at 10. China's trading at 9. Small caps are trading at 10. Stuff is super cheap. All we have to do is survive. If you can buy the market at 10 times earnings, do that and then just go away, right? I mean, just turn off the TV. I'll talk to you 24 months later and markets will be 20% higher, at least on average.
So I think what I heard there was you don't want to lock in your loss and then miss one of what could potentially be a few big days that take us back north of
Massive, right?
Yeah.
So if you sold at 36.66 on June 16th or whatever it was, you missed a 17.5% rally. Now the market's right back. Actually, the market's at 37.25 today. So we're above that still. Came back down.
He does this all the time. He does really have all of that. Just
so it came back down, but we're still above that spot, right? And our call then was that we'd be higher into year end. I didn't say it was going to be like this, right? It ends up being volatile, but the trend is higher. So the market's smart. It knows all this. So why the heck is the market up 500 points on a Friday when there's no news? Because people are doing this math and they're saying, wait a sec. All right, if we're getting towards the end of October, which is known as the bear killer, and there was a big capitulation day in October, we've got the election getting ready to happen in early November. There's never been a 6-month period post that election in the midterms where the market was negative. We know we're going into recession. It is no secret. In the first quarter of 2023, we're going to have inflation that supports earnings. So we probably don't have an earnings collapse. We're trading at 15 times. I'm just going to buy some of that. So the reason the market's rallying amidst all the bad news is because it's a forward-looking mechanism.
got it. So what are you advocating be done in, I know we can't speak specifically about the WNA portfolio, but, thematically, what should people be thinking about with their portfolios? The worst thing, to hear when you're looking at your account value is just stay the course, do nothing. What should people be doing?
So it's important to look at asset allocations. The queer thing about this environment is that bonds and stocks are down, enormously at the same time. You don't typically see that. But the decline in the bond index has created yields again, right? So the fixed income modeling that we do for our clients calls for, 5% yields or returns over a long period of time on bonds. We have not been in that kind of environment because interest rates have been so low. Now, when you look at yields across the spectrum, we're getting closer to that sort of 5%, right? So we're getting back to more normalized rates of return on fixed income, which is great news. Equity portfolios have come down a lot, so people are probably underweight their asset allocations, and asset allocation is the most important thing, which is why you need financial advisors to help you figure out what the right asset allocation is. So rebalancing is important to move money back into those areas to decrease cash positions. Again, fixed income from here forward generates positive carry, and equities going forward at these valuation levels historically are a good buy. So some of that cash goes to work. Let's correct the asset allocation. The other thing that we're doing, and we were in a 3-hour investment committee meeting yesterday, is making sure that we're taking all the tax losses we can. Now, that doesn't mean we sell a position and we go to cash. What it does mean is we sell a position and simultaneously buy another position that gives us the same kind of market exposure, right? So booking tax losses is very important.
Because it allows you to take it a little further and explain what that does for everyone when we...
It guarantees a return, right? So if I can book a tax loss, I'll save 23.8% on my capital gains going forward.
Got
So
it. By book a tax loss, you mean sell it for a loss and keep it to offset selling something at a future gain.
correct. So that's mission critical. And way too often I find that people aren't doing that. Advisors aren't doing it. Clients aren't doing it. So they're leaving money on the table by not doing it. Unless you just love the government and want to give them more money. Because you can if you'd like, but that's not what we do here. So that's important. And then also recognize that this is not a time to get cute, right? They're not being rewarded for going afield and picking an individual stock that seems like it's really got a good business, et cetera. When money comes back into this market and their records amount of cash, it just buys the market. It buys the S&P, it buys the NASDAQ, it buys the EFI, which is the International Developed Index, it buys the Emerging Market Index. The first place money goes is to the indexes. It doesn't go try and sort out whether Coke is better than Pepsi. It just buys American large cap stuff. So this is not the time to go try and bet on individual issues. That'll come later. The early money that comes in just washes into the index.
So go the road most traveled.
Yes.
Kind of go where everyone else is going.
Correct.
Okay.
Exactly. Because what all that really matters, and this is my gray hair talking, in markets is money flows. So if you can be where the money's going to flow, the water rises, right? If you
So I think some people do get a little bit confused in that because we also hear you talk about being contrarian. So can you talk about how these two things are different? So, because sometimes if you don't know all the jargon, you can hear you want to be where everyone is. And then other times you hear you don't want to be where anybody is because that's the best place to be. So can you, explain a little bit about that?
So if I have a flaw as an investor, it's that we tend to be early, probably. But I want to get ahead of the money flow. Here's an example. Let's take an always a controversial topic. Let's take international stocks, right? Stocks outside the US, in war-torn Europe and China-plagued Asia and blah, blah, blah. So we looked at, I can't talk, I guess, about the investment committee and our individual machinations, but I'll tell you, we looked at a holding yesterday that had 7 times earnings PE, right? PE of 7, US is trading at 15.5, 7 times earnings, which is where the US market bottomed from a PE perspective in 1980 after all of that. I mean,
this is on sale.
Cheap.
Okay.
I mean, so cheap and forgotten and unloved and lovely because of it, right? So there are 3 ways to win offshore. One is the valuations are so ridiculously low because nobody wants to own anything in Europe. 2, the dollar at, up 20% this year, at some point is going to roll over, right? That's the way it works. And so when that happens, you're going to get a currency tailwind. So you've got currency tailwind, you've got low valuations that can rise, and then you've got what will be at some point a recovery in earnings. So you've got 3 ways to win: currency tailwinds, low valuations that can rise, and also earnings that can rise, right? Okay. That is a juicy opportunity. Now, when is the money flow going to go there? It'll go there once the dollar starts declining. When is that going to happen? I don't really know. Maybe the first quarter, maybe the second quarter. I don't really know, right? But that's an opportunity to be ahead of the money flow. In the US, you can buy the market and be ahead of the money flow because people are so bearish. Everybody's hedged in the sort of professional trader community. There's a ton of cash around. People are trading it. Sentiment levels are really depressed. And so there will be a wall of money that just comes into the market, and you're seeing it on a daily basis. I mean, we moved from down 100 today to up 700. I mean, we're seeing these kind of moves. When a little bit of money comes in, it moves a lot. Right?
So I think what I'm hearing is use your contrarian outlook to find the opportunity. And then once you decide on the opportunity, that's when you don't get cute.
Patience.
You just want to follow the money flow.
Yeah. Patience, okay. Right? We know, right, that we live in a world of uncertainty. And so I don't really know what's going to happen in the next 6 weeks, but I know what the historical record suggests as highest probability. And so you have to invest on a probability scale. And the probability is the dollar can't continue to go like this forever, because you're just going to ruin the world if you do. So the dollar is going to have to roll over, and it's going to unlock these opportunities, and they're going to be really combustible, but I don't know when that's going to be.
Combustible in a good way, meaning
Yeah.
returns will start. Okay, just
Correct.
want to be sure we're on the same page.
Yeah.
All right, so I think we've been rolling for about 30 minutes. We should probably wrap it up. What are your final things for people to keep in mind as we head into the fourth quarter? Things they should be thinking about their accounts, ways to make lemonade. You already talked about tax trading. What are some of the, people feel better when they're doing things, when they're taking action? What are some of the actions you would recommend?
When the media and everybody profits on all of us being short-term focused, clicking on this and panicking about this, that invites the biggest behavioral errors that investors can make. They get sucked into a conspiracy theory, or they overinterpret, amplified data. This
Twitter?
is a
Is Twitter part of that?
Yeah, I mean, I'm up 3 o'clock in the morning going through the Twitter feed, trying to decide, is that information or hyperbole? Is that information or hyperbole? And 90% of what I read is hyperbole, and I'm searching for the information within, and about 10% of it is actually useful, right? So yeah, I mean, I'm in that stream too, and I have to determine what's fact and what's fiction, or what's hyperbole and what's, legit. So putting behavioral biases away is extremely important right now, because the markets really want you to make mistakes. That's how traders make money, right? We sell them stocks cheap, and then they run up, and then we repurchase them, and then they roll back over. The markets haven't moved at all from a level standpoint since mid-June. There's been all of this, tons of opportunities to make mistakes. Tons of opportunities but it hadn't actually moved, right? So longer term investors have to take advantage of trader volatility by figuring out where the shiny nickels are, and then having the patience for them to pay off. That's kind of what I was saying about Europe at 7 times or whatever. So there are opportunities, but there's no way to take advantage of it in a short-term time frame right now. You will get burned. So keep your hands and feet inside the vehicle, and we're just going to cruise on down the road, and then wait 24 months and open your statement then. And work closely with your investment advisor, because here's the other thing that's important, and we had a new client sign up yesterday. When we do financial planning correctly, we give people the percentage opportunity that's going to work out, right? So if it's 40%, then financial planning's got to do some magic. If it's 92%, then you're good. What people tend to pay attention to is the market's down 24% and they get kind of panicked. What hasn't really changed is the percentage probability that their financial plans are going to work out, because the financial plans already contemplate market volatility. So maybe you've gone from 92% to 89. Now, how do you feel? Right? Market's down 24, you feel bad. Your percentage chance of success went from 92 to 89. If that's really what matters, then how do you feel now? You feel fine, right?
That I think is such an important point. I'm not sure everyone realizes how much the investment committee contemplates a down market. Can you talk, we'll wrap with that. Can you talk about, when you are doing an asset allocation, how much of a foregone conclusion is it that the market is going to go down, and how much a part of that is involved in the planning that you do?
Well, we have a facility within our equity model. I'll just talk about stocks. We have a facility, 20% of the portfolio, where we can hedge. So let's say we got maximum bearish, and this has been a very odd environment, so I can talk about that. We did hedge back in 2019. That worked out, right? So we think about risk management. What I think about a lot, and I mean a lot, is how much gross market exposure do I want to have? If I'm bullish, then I want to be 100% exposed to the market, or I want to be 110% exposed to the market if I can find some things that have more upside than the market in general. If I'm bearish, then we want to be less exposed to the market, right? So coming into this year, I can't talk about returns, but one of the decisions that we made that was correct was taking down that market exposure risk. And that's protected us on the downside. So yes, we are absolutely thinking risk and returns in equal weighting. And so that drives a lot of most of the discussion we had yesterday was about bond market turmoil. What are we going to do about it? How are we going to tax harvest? Where are we going to redeploy capital? Where can we tweak the portfolio? So it's a real-time discussion. So only the paranoid survive in this business. I think about risk first and returns second.
Well, Mr. Paranoid, this was very, very enlightening for me. I'm around you all the time and I hear you talk about markets all the time, and I always pick up something new every time I hear you discuss this. So I'll let you wrap since you started.
Right.
That's all the questions I have.
I may say the same things over and over again in these closures, but it's so important to me. It may sound kind of trite, but I just want people to be happy, right? And so if you can afford to pay somebody to worry for you, do that, and nobody worries more than I do about all this stuff. So we're taking all that on. We're thinking about all the risk. We're doing all the work. Nobody's going to outwork us, right? Nobody's going to outwork us. So I feel really good about our positioning right now. Now, it's no fun to go through a down market, but I've also been in environments where mistakes have been made and you've amplified, and that's just an unbelievably awful situation to be in. That's not a position we're in. So we're doing fine. We've played it correctly. We're exposed, but we're not overexposed. We're starting to take steps towards maybe adding a little risk for the reasons that I detailed based upon the historic probabilities. So we're getting closer to the end of this cycle. And, the ingenuity of corporations and the capabilities of corporations is what we focus on. Don't let the governments and all their craziness drive you crazy, because we don't invest in them. We invest in corporations and they're doing great. So in closing, I will say thank you. If you made it all the way through the end of this presentation, it's an absolute privilege to have responsibility for the stewardship of your assets. We are on the job and we are here to communicate. So if you want to talk any more about this, it is my favorite subject. And Teresa, you do an excellent job representing the clients. So thank you for once again role playing that. And then we'll go back to making them read for a few weeks and we'll see if we get good comments on this, and we'll do it again.
Sounds good. Bye, everyone.
Thank you, everybody. Have a great weekend.